This video will introduce you to some of the economic variables that we see in macroeconomics. I've pulled this data from the Federal Reserve Bank of St. Louis, FRED. It's a really cool website. You can add these widgets, see these graphs that I have here. Let me scroll down for you. You can add these graphs quite easily, and if you set it up properly, these graphs, you can give it a name, save it. They're called dashboards, and it'll automatically update for you. So it's really convenient because I teach a lot of finance and economics courses, and I'm always showing students data. And so it's pretty nice just to jump into this website, pull it up, and know it's going to be up to date as much as possible automatically. So here, for example, on the left here, I have the S&P 500 index and the VIX, the volatility index. Now, that's volatility index is a fear index that you often see in the financial markets. And as you can see it, look at it skyrocket up around 2020 during the coronavirus. You see the stock market taking a major dive here. So what's important about the stock market is, one, it's a measure of wealth. It's very important. But even more important than that, another reason, is that the stock market's a forward indicator. It's a leading indicator, meaning stocks are valued based on what people think is going to happen in the future. So when you take a finance course, you'll see that. You'll be calculating dividends in the future, not looking past. You're looking into the past. You're looking into the future. So it's an indicator of what's expected to happen. So the stock market dropped dramatically, and it's rebounded significantly. It's significantly coming back, if you can see that blue there. Now let's look at some other variables that are important to this course, and just to give you a better context of what macroeconomics is all about. So here's the consumer price index, the CPI, bouncing around, ballpark average 2% over the long run here. When I say long run, I'm only going back maybe 10 years here. And you can see a drop in the consumer price index. It's still positive. So we still have positive price gains, but they're almost zero, and you can see it drop off. There's much less inflationary pressure because of the slow economy, and we'll talk about that in coming chapters. Now here's the effective Fed funds rate. We'll see this in a later chapter. This is the interest rate that banks charge each other on loans, and the Fed attempts to manage this interest rate. And so the red represents the actual rate. And then next to it here in blue is the University of Michigan's inflation expectation series. So what it's saying is, look, interest rates, right, follow inflation expectations. And so we're going to see that in the Fisher equation in an upcoming chapter. So it's kind of remarkable. Look at how connected that is. Now let's look over here. Here we got the 10-year. Whoa. We got the 10-year 10-year Treasury rate. It's 10-year Treasury notes, and this is the interest rate associated with it. As you can see, over the past 15 years, interest rates have come down dramatically. They've come down dramatically just recently because of the Fed flooding the economy with money. We'll talk about that in a later chapter. But the reason why we look at the 10-year rate is this is probably the most popular benchmark of all interest rates. There's thousands of interest rates. And we kind of crunch it down into one or two interest rates that we look at in this course. We look at the Fed funds rate. We look at a generic interest rate. And we don't really talk too much about this rate, but this is a pretty good barometer for mortgage rates. That's why we're looking at it here. Turns out that 30-year mortgages tend to only last about 10 years. People sell their houses, get rid of the mortgage, they refinance. So a 30-year mortgage only lasts about 10 years, hence this benchmark interest rate for mortgages. So now here's 10-year mortgages again, 10-year constant maturity Treasury notes issued by the U.S. Treasury. That's what Treasury notes are. So they're bonds. We're looking at bond yields. And so here is the inflation index on those. And so this is what we call a real return. So this is the real return in red. Blue is a nominal return. And the difference, as we'll see in the Fisher equation, is inflation expectations. So you can see here that inflation expectations right now are about 1.5% over the next 10 years is how to interpret that. So that's about 1.5%, and that's the average inflation rate that the market anticipates over the next 10 years. It's covered here is the break even. See right here, break even. This is called the break even inflation rate. That's basically what we're looking at, the difference between those series. So inflation for the next 10 years was to be about 1.8, and then it dropped off a bit. We're at 1.2% per year average. And let's come back up here. Now here, look at this. Look at the, here is the 4-week moving average of initial claims. Look at that spike from people becoming unemployed, and look at it coming down dramatically. So we had a labor report that came out. There were jobs were estimated to grow at 2.5 million, which was outrageously unexpected. And so the stock market went up about 900 points. And, most analysts were expecting huge losses in the millions, jobs that were losses in the millions. And here it turned completely around. So people are expecting possibly a V-shaped recovery, not a W, not a U, not a long drawn out L. There's maybe a V. Okay, so here's crude prices, very important. So you see crude prices dropping dramatically in the coronavirus here, and they're recovering a bit. People stopped driving, and so the demand for oil dropped off dramatically. Well, demand drops off. Hey, price comes down. So that's what we see. Here's unemployment rates. Now, this is an interesting graph. There's various forms of unemployment that we really don't get into too much here. But here is total unemployment, and that's called literally total unemployment. It's in the blue line. And the unemployment rate that you hear about in the press is called the unemployment rate. It's the official unemployment rate called U6. Believe it or not, you got these funny things. The point is that the official unemployment rate is in red, and there's actually more people than the official unemployment rate indicates that are unemployed. And that's because there's people like, for example, marginally attached workers who can't find full-time jobs. There's different types of people with different reasons for being unemployed, and that's what these time series are trying to capture. But you can see that gigantic spike in everything going up here, and all three series that are going up. There's M1, and this is the M1 is a definition of the money supply that we'll cover in a later chapter. And it's a discontinued thing, discontinued multiplier. But we look at this multiplier for M2, which is another definition of the money supply. And as you can see, the money supply multiplier is a little less than 1. You'll see that in a later chapter, later video. Here's labor force participation. This is the percentage of people between 20 and 54 who are actually working. And it's usually, in that category is usually in the 80s, right? And now it's dropped down to about 80. That's a significant drop. Look at the history. This is going back all the way into the 1950s or maybe 1940s. And look at the significant drop. So that's that's not a good indicator that it's dropped. It means it's consistent with the unemployment skyrocketing that we just saw. Now here over to the right is business sector labor productivity. We have a whole chapter, a video on labor productivity, and this is an estimate of labor productivity. Now it doesn't show any big drops because it doesn't get updated that much. Now here, by far, I think if you look at all of the macroeconomic variables we look at, if you want to see the business cycle, this is it. It's when you look at unemployment in the red, back and up and down, and the shaded, by the way, the shaded areas are all recessions. I should say that now. And a recession is basically defined as 2 periods of negative GDP, gross domestic product growth, which if you don't know what gross domestic product is, you will soon, because we're going to cover it right up front. And so here's the actual unemployment rate. So you see after the Great Recession, unemployment coming down. And then if you look carefully, you can see it spiking up. What's interesting is there's a blue line here called the natural rate of unemployment. And that's consistent with potential and full employment growth. We'll talk about that. So this is like an average of where we should be. And you can see in economic booms way up here, we have very little. When we have economic booms, we're down below here, I should say. When we're down below here, we have low unemployment. And then when we hit recessions around the shaded areas, notice around the shaded areas or right after the shaded areas is when when the actual unemployment rate skyrockets up. In this later chapter, we'll look at reserves and required reserves in the banking system. And so here you see a shoot up of reserves in the banking system. What that says is basically the Fed has given, the central bank has pushed a ton of money into the banking system to banks. But the banks have not lent it out. And so they're in what's called excess reserves. So kind of think of that as money in the vault of the bank that hasn't been lent out. Now, required reserves are, we'll talk about what those are. That's in the red. Required reserves are, for every dollar you deposit in a bank, the bank has to maintain on hand basically 10 cents on reserve. 10 cents needs to be in the vault or at the Federal Reserve Bank. And that's why it's Federal Reserve. It holds reserves for the banking system, which we'll talk about for quite a while later on. Let's see, here we have M1, another measure of money supply. So here's checking accounts. Deposit, see this total checkable deposits here? Look at it skyrocketing. That's the money that getting pumped into the economy by the Fed. Here's the money supply. M1 component. That's, I should say, the currency component of M1. So M1 money supply is made up of currency that's like in your pocketbook, and in cash registers, plus checking deposits. And so this here, the M1, the blue line, is just currency that's in people's pockets, and the total checking deposits is in red. That's what's sitting in a bank. Here's the changes in M1 money supply. It's basically money supply growth, which is important. Here's M2, another definition of the money supply and how it's changing. Here's the value of the dollar. It hasn't changed a whole lot, during the virus times here in 2020. But it just signals what is the value of the dollar relative to a basket of other currencies. And the currencies are all weighted by the amount of trade they do. So it's a weighted average. Then we come down further. We have more currency to deposit ratios. As we'll see, it's the ratio of currency that's in your pocket to how much money you have in a bank. That's important. The Fed actually calculates these things. What it's saying is that for every dollar that you have in a checking account, there's about 80 cents in terms of currency that's in people's pockets at this point. And you might think, wow, that's 80%. That's is that the way things work with me? The amount of money that I have is about 80% is in my 80% of my deposits in my pocketbook. Not really. It turns out that a whole ton of currency in the U.S. It's not in the U.S. U.S. currency is floating around in other parts of the world. There's lots of other countries that have adopted the dollar as their currency because they have a reckless political system and they can't seem to keep a stable currency. So they do what's called dollarization. They adopt the U.S. dollar. And then also dollars are all over the world because it's used for drug trade and illegal activity, especially $100 bills. So most of the money that's overseas is in currency is $100 bills. Here's just China and the foreign exchange rate. So it's often heard about on the news. We don't get too deeply into foreign exchange, but we do touch it a bit. And here's more reserves. I'm not interested in this right now. Here's the Fed funds target rate. We have a lot to say about that in a later chapter. Interest rates, the Fed sets rates, the Federal Reserve. Increased rates, and now look at dropped rates to spur the economic activity in the economy, to spur the economy. And we'll talk about what that means. Here's the effective Fed funds rate, the actual rate, interest rate that we'll talk about. Here's another picture of excess reserves. And excess reserves, if you recall, is the amount of reserves that are held by banks that are not being lent out. It's money in their vaults. Now look, if you look carefully at this graph, there's the blue line right here. Before 2010, that blue line was so small, you can't see it. It's basically zero. And then look at all of a sudden, reserves shoot up. That's the Fed pumping trillions of dollars in the U.S. economy in 2010 in the Great Recession because we had a liquidity crisis. And how do you solve a liquidity crisis? Well, you add a lot of liquidity to the market. And so we'll talk about how that actually works. And so here we go, big shoot up. And we were coming down. We were trying to get back to normal. And look, the coronavirus hits and we went right back even higher than we were before. So that's got to come down. That's going to be an issue later on in our country. How to get rid of those excess reserves. Here's a Wilshire 5000. That's just another market index, stock market index that's broader. It's about 5,000 stocks. Now here, this is a very important graph that we'll see time and time again. It's gross domestic product, and it's real, meaning we've backed out the inflationary effects. And then here is potential GDP in red. That's estimated by the Congressional Budget Office. And you can see it's basically where the economy should be under normal times. If you get rid of the business cycle, and you can kind of see the business cycle here, it's kind of smashed down and crunched down. You can see it like I showed you better with that unemployment, the wiggly unemployment series. But look at this. This is pain. This is unemployment. This is unemployment now. Here, we haven't updated things yet. Just calculating GDP is slow. It doesn't come out that often. So that'll take a significant drop down. It already has a bit. But that's a very important variable in this course. Let's see. Reserves, it's come down. And here's productivity growth, which is another important part of this course. We talk about literally productivity in a chapter. And so here is it jumping around. Productivity is how much you and I can produce given a certain amount of resources. And it turns out that productivity jumps around. As you can see, it's kind of volatile. But there are times when it's really good, like it was in the late 1990s. Look, it's positive. It doesn't go negative too much. Then it jumps around dramatically, and we've been on the past 10 years at a much lower rate, if you can see that. We're around a 0.5% averaging productivity growth. That has truly long-term important implications. And so we'll have much to talk about that. So I hope you get a feel for some of these variables that we're going to be looking at in this course. And I don't want you to try to memorize this. I just want you to use this video to get context that what we're talking about in the textbook and in my videos is stuff that's out there. It's in the real world, and there's tons of data on it. So you can actually get this data if you're interested and look at this and start analyzing the economy on your own.